U.S. markets are crashing. They're already down over 46%, which is already worse than the height of the pandemic panic back in 2020. But a lot of people don't see it because they're using the wrong measuring stick. Every recession of the last century involved a massive devaluation of the dollar versus gold as a warning of worse times to come, and we're seeing this now. But most people don't notice because the government has gotten really good at hiding the truth. The dollar didn't buy what it used to, and the Trump administration's plans to continue this devaluation. So in this video today, we're going to be getting into how the government lies to us, how the Trump wants to devalue the dollar, and how these recessions tend to continue once the dollar starts devaluing versus gold. But before we get into that, my name is Joe Franklin, and here at the Mustard Seed, we're all about putting faith to finance. But today we're going to be talking mostly about how the dollar is losing its value massively versus gold, and how we want to value things versus gold dollars instead of real dollars when we're looking at recessions and things of that nature. So let's get right into that. So what's happening with the dollar has happened with every single currency over the history of time. Unfortunately, every single currency eventually becomes worthless, and we don't want that to happen with the dollar overnight. We can see this going all the way back to Roman times, and what they saw was that the amount of gold and silver in the coins continued to decrease over time. The Roman Empire started to break apart, and part of it had to do with the coinage because they knew that the coinage wasn't worth what it used to be worth. So today we're seeing this with the dollar, and it all started in 1933 when Franklin Delano Roosevelt decided to confiscate all the gold. And we used to have these 1 ounce gold coins that were worth $20. And right after FDR confiscated all the gold, suddenly 1 ounce of gold was worth $35. So overnight, the dollar is worth over 40% less than it was the day before. And all these people who turned in all their gold, they're suddenly wondering, well, why do I not have my gold? Because my gold would have been worth so much more. We weren't allowed to own any gold until the mid-70s. And so now that we can own gold again, people can see the value of their gold going up. The dollar was trading right in lockstep with gold for a long time, from 34 through 71. And in 1971, 1 ounce of gold was still worth $35. But once Nixon took us off the gold standard, the value of gold started to skyrocket. So we had the massive inflation of the 1970s. And by 1980, 1 ounce of gold was worth over $2,200. And we've seen the inflation that started in 2021 that's continuing even to now, even though a lot of people aren't recognizing it. A lot of people like to look at what the government says the inflation rate is, but what the government says the inflation rate is isn't what people really recognize as far as the value of homes, the amount you have to pay for eggs at the supermarket, and how much everything all around costs. The government doesn't always recognize how much inflation we're really seeing. The way they measure inflation causes inflation to look like it's a whole lot less than what it would look like if they measured it the way they used to. In Roman times, when they were reducing the amount of gold in the coins and the amount of silver in the coins, and they're reducing the size of the coins, that told a lot of people that the value of the coinage was worth a lot less. But guess what the US did? They got rid of the coins altogether. So in the last 50 years, the value of gold versus the dollar has gone up over 100 times. And a lot of that has been just in the last few years. We could see that the size of the coin would have been reduced by 200 times between 1933 and 2025. Most people notice those things, but when you have paper dollars or even digital dollars, people don't notice those things quite as much. So the S&P 500 has never been more expensive versus gold than it was in the year 2000. Since then, it got a lot cheaper all the way through 2011, and from 2011 to 2021, it got more expensive again, and now gold is taking the reins again. But if we look back to the 1970s, we can see that gold got a lot more expensive versus the S&P 500. That means the S&P 500 got a lot cheaper versus gold in the 1970s going into 1980, and we're nowhere near the levels that we were back in 1980, which leads us to believe there may be a lot more room to run for gold, or a lot more room for the market to come down versus gold. Most people think that the value of the stock market has actually gone up since 2021. But what they don't realize is that they value it in gold dollars, that it's already down 46%. Imagine living in a world where everything's measured in meters, and suddenly those meters get changed to the size of feet. So suddenly you're going to be 3 times as tall. You're going to have to travel 3 times as far to get anywhere, but your car is going to be able to go 3 times as fast. So it'll be nice being 3 times taller, but we're not going to like to have to travel 3 times as far. It's nice to go 3 times as fast. It's nice to live in a house that's 3 times as big, but these measurements don't mean anything. We want to use measurements that are a stable unit of measurement. The Treasury is guaranteeing that they're going to pay their money back to you over time, and they're going to pay you interest as well. The problem with the Treasury and the problem with bonds is that even though they guarantee you to pay that money back, how much is that money going to be worth? We don't know. If the money's worth half as much as what it was when it started, it isn't worth owning. So that's why everybody wants to own gold. The central banks want to own gold. The foreign governments are buying all kinds of gold. You're seeing India shipping all kinds of gold back from London so they can hold it directly. Russia's buying up all kinds of gold, and China's buying gold hand over fist. Even countries like El Salvador, which is supposed to be one of our friendly nations, is buying gold hands over fist. And so we want to own things that hold its value. We want to trade things that's a good medium of exchange. Maybe look at things like digital gold, which we'll want to get into that in a little bit. But if we notice that gold is going up a lot versus the market, it's usually a sign, unfortunately, of worse things to come. Of course, these European banks are not very happy with the Trump administration, and the leaders of the countries are already talking about selling the dollar and selling our treasuries, but they've been doing that already. Ever since 2018, these central banks have been buying gold, and they've been selling dollar-denominated assets, and they've been selling our treasuries. Back in the 1970s, it happened similarly, and then from 1980 through to around 2018, they were primarily buying dollars and buying treasuries. But now we're going back to a mode where gold is the primary thing that people want to own. Recently, international banking regulations have changed. As a result of the great financial crisis, they put in place these regulations to form a framework to protect from everything falling apart the way it did in 2008 and 2009. And when they did this, they wanted to make sure that they had these risks constrained. Now, what they've done recently is they've changed the rules as far as how gold is treated. Gold used to be treated as a Tier 3 asset under Basel III, and now it's treated as a Tier 1 asset. So what does that mean? When it was a Tier 3 asset, that meant the banks had to discount its value and hold more capital against it if they wanted to transact things in gold. Now what they've done is they've increased gold to a higher tier. They've made it a high quality liquid asset. So that way these banks are going to be able to more easily convert gold to cash with little to no loss of value. So that even during a financial crisis, they can hold gold and not have to worry about being able to liquidate things. So that makes it almost as good as cash and holding on the bank balance sheet. President Trump recently announced his pick for the new Fed chair to replace Jerome Powell. And Kevin Warsh, the new Fed chair, used to work with Scott Bessent under billionaire Stan Druckenmiller. And if you know Stan Druckenmiller, he's one of the best investors who ever lived. And of course, Scott Bessent is no slouch, and they say that Kevin Warsh is pretty sharp too. And this policy that they're looking at is to reduce interest rates, but also stop expanding the Fed balance sheet. And so they're looking to reduce the impact of the Fed on the economy and turn it more into a market-based economy, more in line with Alexander Hamiltonian banking system rather than the European type banking system. This will have pretty big implications on what happens with the Fed and with interest rates and with our economy going forward. But it all plays into Trump's playbook that's spelled out in the Mar-a-Lago Accords that also is looking to devalue the dollar over time. Bessent is saying that the only thing that we have yet to do to really get this economy rolling is to reduce interest rates, and we're looking to reduce interest rates by about 2%. That'll be better for Treasuries, but it's likely also going to prop up gold as well once this new Fed chair comes into power. It's pretty evident that over the last few years, those people owning Treasuries haven't done near as well as those people owning gold. But President Trump has a solution to this, and the solution is gold-backed Treasuries. They'll probably put his name on them too. They'll probably be the Donald Treasuries or something like that. With the gold-backed Treasuries, we'll see what the details are, but hopefully we'll be able to know exactly the amount of gold we get back when they mature, and they'll pay a decent rate of interest. If they pay good interest, that could be a game changer. It may be that we end up with gold-backed Treasuries that are super popular, or it may be that these don't come out at all. Time will tell. The S&P 500 was worth about 2.6 times gold at the end of 2021, and now in early 2026 we're at 1.4 times gold, so it's down 46%. And in 1970 the value was about 2.6 times gold. After Nixon took us off the gold standard, it went down to 1.6 times gold, and then after that it went down even further. The S&P 500 got down to less than half the value of gold. Now, most people think that the worst period for the market during that period was 1973 and 1974, when the market was down over 40%. But when you consider it versus gold dollars, by 1980, we were down over 90%. So this is the actual worst period for the market that we've seen in the last 100 years in measuring versus gold. Now, some people may say that gold just went crazy because the Hunt brothers tried to corner the market on silver, and when silver went through the roof, gold went through the roof, and you could say that gold was going for a lot more than it should have been going for because it peaked and then it came right back down. The next period for the market from 1980 through 2000 was a great resurgence period, and we haven't seen returns in the market that good probably ever, especially versus gold. What we want to look at are the good periods for the market versus the bad periods for the market, and what we want to be watching for when we go into the bad periods for the market. Most people know that we went through the Great Depression in the 1930s going into the 1940s and realize that we had a huge stock market crash in 1929. What they don't recognize is that after the huge stock market crash, the market dropped a whole lot, and then it looked like it was recovering. But when you measure versus gold, it didn't really ever start recovering until after 1942. During that period of time, we had the gold revalued a couple times. Most people recognize that 2000 through 2002 wasn't a very good period, and the 2007 through March of 2009 period was really, really bad. The market was down over 50%. But what most people don't recognize is that since gold was appreciating that entire time versus the dollar, or the dollar was getting worth less and less, the market versus gold dollars was down about 88% between late 2000 and mid to late 2011. That is a period that was actually worse than the Great Depression. But we're now in a period that looks a lot like the early 70s. Gold has done better than the market, especially over the last couple years, and this has happened during the Great Depression, during the 1970s, and during the Great Financial Crisis. Is it going to continue like it did during those periods? Well, we saw periods where we had increasing unemployment during those periods. We're seeing that now. We had periods where we had an inverted yield curve, and the Fed was hiking before the nastiness really started in. We already saw that. We came out of the inverted yield curve eventually during all those periods. We're seeing that now. It's likely we're going to see this again but the government has gotten really good at hiding things. So how is the government hiding this recession in gold dollar terms? Well, they're printing money. So as they print money and as they borrow money, the dollar gets worth less and less versus everything else. So the market can look like it's going up if they print enough money. But if you measure the market versus gold, we're not doing so hot. And if we continue to see all this inflation, all this money printing, all this borrowing, it could be that the market goes up a little bit, but gold will go up a whole lot more. So we probably don't want to be owning as much of the S&P 500 as we want to own of other things, maybe overseas, and things like gold that will hold their value. Since the government wants to pull the wool over our eyes, we want to wake up, see the truth, and determine what we want to own in the face of all of this money printing. They can say that we're not in a recession. They changed the definition of the recession in 2022. Now they tell us when it's a recession, but when you measure recession by the way it used to be measured, then we could say that we've been in a recession ever since 2022. Are we in a recession? Are we not in a recession? If they print enough money, you could say that we're not in a recession, but the value of the dollar keeps going down. The amount that people get paid keeps going down. The amount of people that are employed keeps going down, and it doesn't look good. What we want to own to preserve our dollars or preserve our money in real dollar terms and gold dollar terms would be things like gold, would be things like real estate, be things like maybe some things overseas where the currencies aren't devaluing as much, but they're devaluing all over the place. The devaluation of the dollar is something that the Trump administration has been pursuing, and they've done a good job of devaluing the dollar. It impacts the investments. It makes gold worth a lot more. It makes other currencies worth a lot more. But it sends a lot more jobs into the U.S. and allows for manufacturing of a lot more things in the U.S. And one of the areas where the U.S. is starting to outshine everybody else is in oil production. Right now, oil production has been going through the roof through the end of 2025. And it looks like it's not going to be long before we're producing more oil than Russia and Saudi Arabia combined. We are writing the rule book now as it relates to oil production and petrodollars throughout the world, which makes us the big gorilla on the hill. Also, the tariff revenues have been bringing in more money than expected, and so it's helping to reduce our budget deficit more than we thought it would to begin with. They're spending a lot of money through the big beautiful bill. The money they spend helps to push off the recession, but we can't keep spending government dollars forever and borrowing forever. Unfortunately, eventually we got to pay the piper, but hopefully we'll be able to generate more revenues on the good side than the money that we're spending on the bad side. The U.S. has confiscated gold before, but will it happen again? Well, it's possible, but we see it as unlikely. U.S. citizens are about as likely to want to give up their gold as they're going to want to give up their guns. We don't see that happening. But this is one reason that digital currencies like Bitcoin have become so popular, and the primary reason there is because you can't confiscate it. You can't, in many cases, identify who has it because it's all held on the blockchain. When we look at digital currencies, the key appeal of these digital currencies is that it allows for a lot more freedom of those people who own it. The digital currencies are decentralized, there's clear monetary policy, it's open and permissionless, it's unconfiscatable. When we talk about digital gold versus regular gold, of course we're talking about Bitcoin. And Bitcoin tends to do the best when the markets are frothy or we're in a risk-on period. Gold tends to do better when we're heading into a bad period for the markets or a risk-off period. So gold is a great place to protect your money. Bitcoin is a great place to grow your money in a speculative market. The other thing we got to keep in mind with Bitcoin is that it goes through cycles. We tend to have 3 good years and then 1 bad year. The 3 good years are all revolving around the halving, the period of time when it becomes twice as hard to mine for Bitcoin. That reduces the supply, which increases the price because we are dealing with a supply-demand function. When Bitcoin starts into its good cycle, it's typically about 17 months before the halving. When Bitcoin finishes its cycle, it's about 17 to 18 months after the halving. And you can see this here, where this last cycle, the halving was in April of 2024, and the peak was in October of 2025, so that's roughly 17 and a half months. Now, we can't expect Bitcoin to bottom typically until we get a certain period before the next halving. We can look at Bitcoin summer, which lasts 3 years roughly, anywhere from 33 to 35 months. We can look at Bitcoin winter, which typically lasts around 12 months. When we want to look at periods to protect our money, we want to move to gold. We want to look at periods to speculatively grow our money during risk-on periods. We might want to look at digital gold. So since you love this video so much, please feel free to put those thumbs up and subscribe to the channel. Also, we got this video right here we think you'd like, and we'll catch up with you next time.